Trading options is not restricted to just your taxable accounts. In this webinar, we'll introduce you to option strategies that are available in retirement savings plans, RSPs, TFSAs, tax-free savings accounts, and retirement income funds, RIFs. Our guest, Jason Ayres, instructor at the Montreal Exchange, will start by going over the basics of call and put options. He'll build on the basics by exploring some option strategies that you can use in your registered accounts, like preserving your capital or generating income. And without further ado, here's my guest, Jason Ayres. How are you, Jason?
I'm doing well, thank you. How are you doing today?
Oh, I'm not too bad, not too bad. I know that you have to go through a quick disclaimer, quickly, before we get started. So I'll let you do that, and then we'll get to the fun stuff, right?
Absolutely. Well, listen, in the spirit of satisfying our legal and regulatory responsibilities here, we just want to make sure that everybody understands the information we're going to be talking about today is for educational purposes only. And of course, options, not unlike any financial security, does carry with it some risks. So we want to make sure that everybody understands those risks, of course, before they start using them within their registered accounts, as we're going to be discussing here in this webinar.
Excellent. Okay, let's get to the good stuff. Can you give us a quick summary of, where we'll be going today when it comes to our discussion?
Yeah, absolutely, Ryan. So first of all, we want to take a look at some of the different objectives and considerations that one might be looking at when trying to determine what option strategy may best complement their investment strategy, more specifically within their registered accounts. So we want to touch on some of these different registered accounts, as you mentioned earlier on, some of the opportunities and limitations that they may have, and then again, subsequently looking at the eligible strategies that we can use. Quick review of the basics, because that's where it all starts, obviously. And then we want to get into some examples that our viewers can take a look at and understand, and then ultimately put into practice when they're managing their own portfolios. So
let me ask you this. Why are we having this webinar? Who decides what strategies are going to be used in a registered account anyway? And why do we have to make that distinction?
Well, it's a great question and an interesting consideration. It really comes down to how we are able to use our cash and capital within our registered accounts. So there is a rule that says we can't leverage capital, we can't trade on margin within our registered portfolios. And because of that, we are limited to the types of option strategies that we can use, because some of the option strategies that would be available to us outside of our registered accounts do require a little bit of a different consideration when it comes to how they're classified by our brokers, as far as whether it's marginability is required within that account. So it comes right down to the fact that we can't trade on margin in our registered accounts, so we are limited to the strategies that we can apply because of that.
Excellent. So I'm really excited to get into all those strategies, maybe look at some examples, some more detail. But before we do that, can we do a quick recap of the basics of call and put options?
Absolutely. An understanding of the basics is really important, because the basics are the foundation for everything that we look to do in our portfolio utilizing options. So the first consideration there are two types of options that we can use. And the first of those that I'm going to reference here are call options. Now, we can be on either side of the trade when it comes to utilizing a call option. So we can be a call buyer if we feel that that's the best strategy to suit our outlook. And the call buyer pays a premium and secures a right. So you got to think of these as contracts. So we're buying a contract, we're going to pay a premium, and we're going to secure the right as the call option buyer. And that right is that we can buy 100 shares of the underlying security. Whether it's a stock, whether it's an ETF, we are paying a premium and we are securing the right to buy the underlying shares at a specific price. Now, on the other side of that transaction is the call option seller or writer. So the call option writer says, hey, that sounds like a great idea, but that's not what I'm looking to do. I'm looking to generate cash flow. So because of my different outlook, I'm going to sell you that premium. I'm going to sell you that contract, and I'll take on an obligation. I need to get paid for that obligation. So you pay me the premium, and I will deliver those shares, those 100 shares, for every contract that I sell you, if and when it actually hits the specified price. So there's your two sides to the transaction, and we're going to look at why we may consider being on one side or the other shortly. The next is the put option. Now, much like the call option, the put buyer is going to pay a premium and secure a right. But that right is, in fact, to sell 100 shares for each contract that is purchased. So you've got somebody on the other side of it that has a completely different outlook and says, that's all well and good, but I would like to buy that stock at a cheaper price. And I'd like to get paid to wait. So while you're buying this put option to protect or to speculate, I'm going to sell this put option to generate some cash flow. So if this stock drops, I'm prepared to buy that stock from you because that's what I want to do, and I want to get paid to do it. So again, two different investors coming to the options market with two different outlooks and objectives, taking either side of the trade.
Okay, that's good to know. And as just before we get to those strategies, I know there's some more terminology we're going to talk about, such as strike price and expiry date. Could you go over those real quick?
Yeah, absolutely. So again, it's all about the details. And each contract has their own unique specifications that we need to look at and determine whether or not it's the right, set of specifications for us to meet our objectives. So one important consideration is the strike price. So I talk about, the fact that options are contracts. They have rights and obligations associated with them. So the strike price is, for the call option, the price at which I'm securing the right to buy the shares at, right? So it's the price at which I can purchase the shares at, based on the contract that I purchased, or if I sell that call option, it's the price at which I'm obligated to deliver the shares at. So when I'm trying to figure out how best to position myself in an opportunity, the strike price of the option contract is extremely important because that is going to be very influential on how I manage the position and what I should expect out of the position as it evolves in the market. For the put option, the strike price is essentially, as the buyer, price at which the shares can be sold. So again, very, very material in the decision-making process. The next and equally important consideration is the expiration date. So first and foremost, you need to recognize that options have an expiration date. Many investors are simply used to, buying and selling stocks, which, as long as the stock stays in business, you can hold the position indefinitely. Options have an expiration date, and you need to be prepared to manage for that as you enter a position into the market. Now, as the buyer, what that means is if the stock doesn't move as anticipated within that time frame, the option may very well expire worthless. Now, that is beneficial to the option writer, who in fact wants to see the option expire worthless. So again, different sides of the trade and what your objectives are going to be, deterministic into as far as what the expiration date selection looks like for you. A lot of these decisions can actually be made before you go in and take a look at all that information that's available to you. So important consideration as you're obviously setting up for a particular trade. What are your objectives? Do you want to use a call or a put to meet those objectives? Do you want to be a buyer or a seller in order to do so? And what strike price and expiration date are going to be appropriate for you to get to where you want to go?
All right. Nice recap. Now let's get to those strategies. So we're able to buy a stock in a registered account. And I know you mentioned your first strategy, which is buying a call option. Why would we do that instead of just buying a stock outright?
Well, there's some really interesting considerations here. The first is that we have the ability to leverage our capital. So I mentioned you can't trade on margin in a registered account. Normally in a non-registered portfolio, you could go in, and if you're comfortable with the risk, you could, for X amount, you can control 3 times the number of the amount in shares. It can work, but it's a double-edged sword, right? So they don't allow you to do this in your registered account. But what you can do as a replacement strategy for that is use a call option to leverage your capital. So you can basically control a significant number of shares for a limited amount of capital, as we're going to look at in the example here. And the risk associated with that trade, with that opportunity, is limited to the premium you've paid. You can't lose more than what you paid for the contract. So you can go into an opportunity knowing exactly, no matter what happens pre-market, after hours, you know exactly what your maximum risk is going to be when you place the trade. So, for those of you that are looking at, maybe contributing to a TFSA, and your objective is, hey, I want to maximize growth and I want to be able to diversify a limited amount of capital across, different opportunities, using call options and participating in those different opportunities because you don't have to put up as much money is a great way to do it. So we're going to take 2 investors, both bullish on a particular stock. We're going to call that stock ABC. The shares are trading at $45. Investors have a belief, an expectation that the shares are going to rally from 45 to 55 over the next 3 months. All right. So based on that consideration, we can actually look at some details, both from a buyer of the stock's standpoint or from the other investor who might consider to be the buyer of the call option. So the buyer of the stock, the buyer of the shares, really simple approach, which most of you are probably familiar with. You've got $45,000 in your portfolio that you're comfortable allocating to this opportunity. You can buy 1,000 shares because the shares are trading at $45, and away you go. The alternative, which you may not be familiar with, is utilizing the call option as a long stock replacement strategy. So in this case, we want to give the stock enough time to make a move because we remember there's an expiration date. So our expectation is over 3 months, this stock is going to move to $55 to our target. Now, we have to choose a contract that reflects a share value or share price where we would like to mimic a position. So we're not always going to see the exact strike price as it relates to the underlying share price. So we're going to go with the next closest thing, which would be the 46 strike call option. And what this says is we have the right to buy the shares at $46 for the next 3 months. No matter how high those shares trade, we can buy it at 46. Now, we want to mimic a position that reflects 1,000 shares. Well, we already talked about the fact that each option contract represents 100 shares. So we simply divide 1,000 shares by the 100 unit multiplier, and it tells us we would buy 10 contracts. So now you can see that when we get down to the nitty gritty here, when we pay $3 per share and we're buying 10 contracts to participate, the capital outlay in this case using the call options is actually only $3,000. So you'll see the person buying the shares is putting up $45,000. The person buying the call options, $3,000. So if we move forward and we take a look at the 2 positions side by side, right, and we look at the stock investor, they're going to buy 1,000 shares. They're going to put up $45,000. Now, risk is a very important consideration as an investor. And if we consider the risk associated with the stock investor's position, we want to recognize that it's undefined. Now, of course, the stock investor can get out of the position at any time, but the maximum loss on that position is $45,000. Now, the investor has the opportunity to benefit from the full appreciation of shares to the target. So if within the 3 months, ABC shares hit $55, then the investor could offset or sell that stock back to the market and pocket the $10 per share for a total of $10,000, right? So that's a great trade, no matter which way you look at it when it goes in your favor like that. However, if we take a look at the call investor, remember that we're putting up $3 per share, not $45 per share, and we're buying 10 contracts to control 1,000 shares. So our capital allocation is $3,000. Our maximum risk is $3 per share or $3,000. So we can lose 100% of our investment, but the fact of the matter is that the underlying shares could drop $3, $5, $10, $15, and we would not lose any more than the premium we've paid. Now, what we want to be cognizant of is our upside opportunity here. When we buy the call option and the shares are trading at or below where the strike price is, so in this case, shares are at $45 when we buy, we're trading a 46 strike, right? So we're buying time, and time depreciates. And so every day that this stock does nothing, time is passing and we're losing time value. So what has to happen over those 3 months in this example is the shares have to rally sufficient enough to offset that time value that we've paid. And then subsequently, as the shares continue to rally, we start gaining what's referred to as intrinsic value, or the real value of the contract. Now, that being said, we can close our position. Shares move real quick. We don't have to hold till expiration. And if they move real quick, the option contracts will still retain a significant amount of their time value as well. So, we can get out of our position profitably regardless, as long as the shares are moving. Having said that, if we look at holding the position till expiration, we need to back out the premium that we've paid from the overall value of the option contract to determine what the profit is. So in this case, if the shares rally from 45 to 55, the shareholder who paid 45 gets $10. For the call option investor, they have the right to own it at 46, which means it's not worth 10, it's worth 9. Beyond that, they actually paid $3 in time value, which is now all gone at expiration, leaving the difference. So we take 9 minus 3, which is the time value, and we have a profit of $6,000, right? So you step back and you say, well, man, I'd rather have the 10 grand. Of course, but look at what you've accomplished with the amount of capital that you've had to allocate. You put up $3 per share in risk, and you're essentially walking away with $6 in return. So your risk reward profile or proposition is quite attractive, right? And that's why a lot of people choose to use call options as a stock replacement strategy, because they put up less capital, they have a limited risk, and they have the opportunity to make a really attractive rate of return if they're correct about the directional move in the underlying shares frame they've allocated.
That's excellent. And just a form of leverage that we can use in those registered accounts. So let's move on to that other strategy that you mentioned before, which is buying a put. What might we consider with this strategy?
Well, for this particular example, I want to specifically look at trading a bearish directional bias. You have the same benefits as I just went through with the call options, in that you're going to participate with less capital and you can't lose any more than the premium you've paid. But beyond that, you can't short sell stock in your registered account. So you can't look at, a stock that's considered a high flyer and say, man, that's way too expensive. I think it's definitely going to drop in value, and say, okay, I want to short sell those shares. For those of you that don't know what it's all about to short sell shares, basically what we are doing is we are borrowing shares from somebody else at $42. We are lending them out to the market, and somebody is giving us $42 per share. So we are collecting the equivalent amount in cash into our portfolio. Now, sounds like a wonderful idea. And you know what? If you're right and the stock drops in value, fantastic. You sold short, you buy to cover, and you give back a portion of what you've brought into your portfolio. You have to find an alternative. So buying a put option is your short sell stock replacement strategy. If we take a look at an example here, shares are trading at shares of XYZ trading at 42 bucks. The investor's got a target of $37 per share. Again, I'm using a 3-month time horizon as an example. Keep in mind, you'll have a number of different expiration months to choose from when you're looking to trade your directional bias, but I will caution you on making sure you give that stock enough time to make a move. We all think that when we get into a trade, we're going to be right the next day. But anybody that's traded knows that's not usually the case. So make sure you give yourself enough time. You can always get out tomorrow, but if your options expire tomorrow, you may be in a little bit of trouble, right? So the option trader can say, I want to do this with a limited and identifiable risk exposure, and I want to do this in such a way that I don't have to put up that amount of capital as a risk. So we're going to pay a premium and secure the right to short the stock at 42. There's 5 contracts. If we wanted to mimic 100 shares, 1 contract. So because we're doing 10, they're $220 per share times 100. We're going to put up $2,200. So the put option buyer basically has $2,200 at risk as their limited exposure. Now, we paid $2.20 per share times 10 contracts, and we have the right to sell the shares at 42. So in this case, our maximum risk exposure is $2,200. So if we're wrong and the shares skyrocket, no matter how high those shares go, we can't lose any more than $2.20 per share or the $2,200 we put up. That is sleep at night comfort, right? You know, many of us get into a trade when we're buying shares, and, you know, as the market whipsaws, it can be a little challenging because you don't know on any given day what your risk may be or where the shares are going to be trading at. However, as soon as you get into this option trade, limited identified risk exposure that you know no matter what happens is the most that you're going to lose. Now, the opportunity here is in where we can put a few numbers to it from the perspective of risk return is if the shares drop to that $37 target within the time frame. Yes, we paid $2.20. Yes, that was all time premium. And yes, that is going to depreciate on expiration. But if the shares drop from the from the $42 market price down to the $37 target, well, that option contract is in fact going to be worth $5 in intrinsic value. Now, we paid $2.20, so we have to subtract that from the net value of the option contract, and what we end up with is a $2.80 profit. So we put up $2.20 risk, and we end up with a $2.80 profit, which if you calculate the return on risk is 127%, right? Don't let that fool you. Risk is risk. And it's a function of how much capital you put into the trade, right? So I always like to caution people on looking at that high return number. It looks great, absolutely. But again, risk is risk, and your risk is how much you put into that trade. So you can lose 100% of that $2,200 in this example if you're wrong, you don't manage properly. Again, remember, you can get out of the position at any time. So as long as there's time left until expiration, you can get out to lock in a profit. You can get out to cut your losses if you feel that the opportunity is no longer an attractive one.
Okay. So let's turn our attention to now generating income. And with that, let's talk a little bit about the covered call.
Yeah, so the covered call strategy is probably one of your more popular strategies, if you will, for registered portfolios. And more specifically, I think RSPs and RIFs and even RESPs, where the idea is that you're not so much necessarily focused on capital appreciation and really driving returns, but you want nice, consistent cash flow. You want to offset portfolio volatility, and you really want to maybe take a little bit more conservative approach, let's say, to how you're participating in the market. So, again, I always try to distill all of these strategies down to it's up to you how you use them in terms of just what you're trying to accomplish, right? So in this particular case, when it comes to, the covered call strategy, how we apply this strategy is going to be dependent upon what our objectives are. So, if your objectives do happen to be growth, versus income and capital preservation, you can make some adjustments to the strategy to help favor growth. Are you more active or are you passive? Again, your expiration date, your strike price selection is going to be part of your decision-making process. Do you want to apply these strategies to stocks versus exchange-traded funds? We have those choices. From the perspective of choosing an opportunity, do you rely on technical analysis, trend identification, moving averages, indicators, oscillators, or are you somebody that's more, considerate of the underlying fundamental, metrics associated with any given company, industry, or sector, or is it a combination of both, or is it a combination of all of the above? So, because we're specifically talking about the covered call strategy in this case, let's take a look at the fundamental basics. So, the idea around the covered call is that we actually buy or we already own shares. Now, of course, the stock has to be, or the ETF has to be options eligible. So recognize that not all stocks and not all exchange traded funds have options, right? So you want to be cognizant of that when you're considering this strategy based on, how your portfolio is currently built. But you're going to buy or already own the shares, and then you're going to sell a call option and get paid up front basically for taking on the obligation to deliver those shares at a specific price, and that obligation is going to be valid for a specific period of time, right? And so, it all starts with making sure you've got a good stock as the foundation. So don't underestimate the importance of your stock selection process. It's stock selection first, option strategy overlay second. So in this case, what you want to consider is that risk-reward profile that we've got illustrated on the slide here. You can see that we have essentially all of the downside of the stock, less the premium we've collected, but we are limiting the upside to the strike price that we've written, right? So therein lies your decision-making process. What strike do you sell? Because the lower the strike towards the price of the security means you're not going to capture much upside, but you'll get lots of premium. The higher the strike means you're going to get less premium, but you'll collect more upside. So depending upon the type of investor you are, what you think about that stock, you're going to choose the appropriate strike price. So we want to recognize, again, we're long 100 shares because that is the number of shares per contract. And in fact, this is why it's referred to as the covered call strategy. The obligations associated with selling that call option are covered by the underlying shares that you hold. And that's why we're allowed to do that in our registered accounts, Ryan, because we have the shares, right? We couldn't sell that call option in our RSP or TFSA, et cetera, if we didn't have the stock, because what that would require is having the cash as collateral, and that's considered margin, right? So again, max gain, stock price minus stock purchase price plus premium received. Max loss, stock purchase price minus premium received. It can be substantial. Don't underestimate the risk of the underlying shares, okay? Covered calls tend to be held until expiration. And that's what I was talking about at the beginning of the slide when we were talking a little bit about the differences between buying calls and selling calls, or buying puts and selling puts. The seller tends to be more passive, wants to wait until time depreciation has kicked in entirely and the option expires worthless. One of two things are going to happen on expiration. Either the option is assigned, and what do I mean by that? Well, listen, you sold the call, you got paid to take on an obligation, And if that stock has rallied at or above the strike price, you're going to get assigned to deliver on that obligation, which means you're going to sell your shares to somebody at the strike price. You're going to keep the difference, of course, but you're also going to keep the premium as well. So it's really not a big deal. You know, going into the trade, into the position, how much you stand to make within that time frame, and you know that you may have to give up those shares if somebody decides they want them. The ideal opportunity is that the option expires worthless. So you own the shares, the stock's gone up a bit, down a little bit, traded sideways, but ultimately the contract has expired and you get to keep the stock and you get to keep premium and you get to do it again the following month.
Yeah, definitely. I know the question really is with covered calls is usually, what strike price do I choose and what expiry date do I choose? That's usually a big question from those who are interested in this kind of strategy.
Well, exactly, Ryan. And it's funny, everybody says, well, what's the best one to write? What's the best approach? There is no best approach. There is no exact right contract. There are so many variables. So what you really need to do is you got to break it down into the basics. If we want to collect a lot of premium, if we don't care about the stock upside, then we may choose to write an in-the-money option. It's where we're going to collect the most, as I said, in premium. It's got very little time value, so we're not getting a lot of return on the trade, on the position. But what it does significantly is it lowers the break-even point on the shares. So an in-the-money call right is more of a hedging strategy. You own the stock, you're thinking, man, things are getting pretty, choppy here. I'm not sure, there's earnings coming up. Let's sell an in-the-money call and let's ride that storm. Let's create a real nice buffer on the position and, focus more on risk management and less on, enhancing cash flow. The middle of the ground strategy for pure income is the at the money. Time value is the highest at the money. And so if we really want to get the most out of our option writing as far as time value premium, at the money call. Well, what do I mean by that? Stock's trading at 40, we sell a 40 call, or we sell a 42 call, something very close to where the stock's trading at presently, where yes, we've limited the upside, but we caught 1% for a month or 1.5%. The opportunity here is that percent or 1.5% or whatever it might be acts as a buffer. So every time we sell that premium of our shares, quote unquote, we're not necessarily lowering the cost basis, but we're lowering the risk exposure, and that helps reduce volatility. The next choice is out of the money. This is where you're saying, I love this stock. I think we've got $10 upside here over the next 3 months. I'm going to sell a call option, $10 out of the money at my target. I'm going to sit back, watch the stock increase, and then I'm going to get paid to take profits at my target. So it's kind of a cool way to trade a directional bias and get paid to take profits. And it doesn't have to be, the full position. What's really neat about this is, as an active investor, if you want to reduce your position size at a certain target, let's say you have 1,000 shares. You know what? Sell 4 call options, 5 call options at your strike price. Sell half the position at your target. Keep the other half and do it again. So many choices that you can consider just by simply looking at the different options within the different classifications or categories here when determining how best to apply the strategy. Now, we talked about expiration month as well, and again, it's always a loaded question as far as what expiration month is the best. If you sell the short term, or what we would call the front month contract, you're going to generate a higher annualized cash flow, but it is more transactional, right? So what do I mean by that? Well, if you're selling weekly or monthly options, the consideration is that you may be selling those shares within a week or selling those shares within a month and then having to buy those shares back and do it all over again. So commissions and transactions are an important consideration. But again, doing it in this way gives you flexibility. Stock goes up a little bit this month, but not quite to the point where you get assigned. Well, then you can sell a further out of the money option for the next month, and so on and so forth. So you can sort of actively manage your exposure and your obligations by selling the shorter term. If you're more passive, the further out months give you greater upfront premium and are less transactional. So you could say, you know what, I want to kind of sit back for the next couple of months, let the stock do what it's going to do, and I'm just going to collect a little bit of premium for my time. So, you know, it's February now, you're holding a stock at 20 bucks. You might say, I'm going to sell a June, $25 strike call. And, you know, ideally the shares are going to head in that direction. In the meantime, I've captured an extra 1% for that period, which, you know, as we know, this is a game of, you know, inches or millimeters. Every little percentage point counts, and we want to capture that when and if we can.
It's good. It's good to know of different ways to generate income, especially in a registered account. So we've looked at that generation of income. Let's now turn our focus on to any strategy that talks about protection or insurance of a stock or portfolio. What strategy could we use then?
Right. So, I mean, we've already touched on the fundamental aspects of using or trading a put option and being the put option buyer. Quite simply, if the stock drops in value, the put premium increases in value. You can kind of think of it how an insurance policy works. The more risk and the more, I guess, damage, let's say, from the perspective of owning car insurance, the higher the premium, right? So if you're holding a stock position and you feel that there may be risk associated with that, you can buy a put option for stock insurance. And as the stock drops in value or gets into an accident, the value of that stock or put insurance increases. So in this case, you're going to buy shares, or you're going to already own the shares, and you're going to buy a put option to lock in your right to sell the shares at a specific price. And again, that protection or that put option contract is valid for a specific period of time. So this is where you have to step back and say, well, how long do I need this protection for? Because we always got to remember time is money. So if you buy a 1 week put, it's going to be a lot less expensive than if you buy a 1 year put. So with that in mind, let's move on to an actual example here. So let's say we own shares of ABC at $42 and we buy a 3-month put at the 42 strike and we pay $2.20. Now this may sound familiar because I use this as the put option example in the earlier slides because the two, it's no different. It could be the exact same contract, right? I'm using it as put protection, as speculators using it to speculate on a directional bias. Either way, it's the same contract. It doesn't matter. In this case, I own the shares and I'm buying that put option for protection. So what you can see here based on my chart is I can participate in all the upside, which is what's pretty cool about this. And therein lies the difference between just buying the put or owning the stock plus the put. Owning the put on its own is bearish. You think the stock is dropping and you want to make money from it. Owning the put as a hedge is in fact bullish with protection, right? So you, again, if you think this stock is gonna collapse, you probably don't want to be owning it, right? So this would be a situation where you love the stock, it's been great, you think there's lots more upside, you just want to buy a little insurance policy because you know what, you're a little concerned about the short term. So what happens is your risk is limited to the cost of the option until expiration. And what's kind of cool about this is that you can choose the strike price that best reflects the amount of risk you feel you need to be protected from. What you'll find is that if we've got 100 shares of the underlying, each of those shares is worth $4,200. We're going to put up $4,200 to own the stock. We're going to buy one 3-month 42 strike put, and we're going to pay $2.20 times the contract, which is a 100-unit multiplier times one contract. We're going to put up $220. Now, we're paying a 5.23% premium for a guaranteed sell at $42 for the next 3 months is 5.2%. So the market could drop 10, 15, 20%. This stock could collapse. But our maximum risk day and night until this thing expires is 5.23%. So we've defined our risk. This is sleep at night, right? Now, what's the trade-off here? The trade-off is your break-even point on the position, because that premium, right, is a cost to you, and it's time value. And what do we know happens to time value on an option contract at expiration? It's worth zero. So when it's worth zero, we need the underlying stock to have rallied sufficiently enough to cover that. And in this case, we would now have to adjust our break-even target, not at 42, which is where we bought the shares, but basically at 44.20, which includes the share purchase price plus the cost of the put option, right? So don't forget that. You add to the cost of the position when you add your insurance. So your rationale is that added cost is significantly less than what my risk is in holding this position through this period of time. If you can't say that, don't buy the put, or buy the put at a lower strike so that you reduce the break-even point, right? So simple sort of rationalization can help you determine what makes the most sense. So having said all of that, if we take a look at how this position could conceivably play out, we would be considering, again, having paid $2.20 for the put option, but with the stock dropping, let's say, from 42 down to 36.50, that put option would in fact be worth be worth $6. In fact, if it's down to, let's just round it out here, the stock drops down to stock's down at 36.50, down to 42, you're going to talk about an average put value of about $6, right? And so with that in mind, you can now step back and say, well, yeah, I've lost that amount on my shares, but I've gained the difference in my put option. So if we advance to the next slide here and step back and consider the difference between simply buying the stock and being the average investor and being that protective investor, the average investor is down about 13%, right? The consideration there is, okay, I'm down 13%. Do I keep holding the stock? Do I get out of the stock? What do I do from this point on, realizing now I'm down 13%? The protected investor is down about 5.23%. Now, the cool thing here is that they have choices. They could get out of the position right away, and they could say, okay, you know what? Yeah, I'm down 5.23, but I'm not down 13% like my neighbor Stan is. So I can, just walk away and find another opportunity. Or I can hold the position because I know I can't lose any more than this. So if I've got 2 months left until expiration, I can simply sit back and say, okay, this was a volatile day, volatile week. I still like the stock. Let's sit back and see what happens. Well, look, if the stock keeps dropping, you can't lose more than 5.23%. If the stock turns around and starts rallying higher, you've stayed with the position. You haven't closed it out. You don't have to now rationalize, since the stock is rallying, about going back in. And you can be more comfortable about how you manage the position. So in other words, you can hold it for as long as you want, as long as that put option's in place, and be comfortable with what your maximum risk exposure is to the position. So what I think is a really interesting consideration here is just the fact that you've got choices.
Great strategies today. Any final thoughts that you might want to leave with our clients today?
Yeah, I mean, I think, the main consideration here, whether you're using options or not, is develop or establish a plan. Determine what it is that you're trying to accomplish. Only you know yourself, only you know your risk tolerances. What's good for me, what's good for you, Ryan, is not necessarily good for, for my mom and dad. And so as an individual, you have to really think it through. And, options are a tool. They're not the answer to everything. They are a very powerful tool to be used as part of a sound investment approach. each of your registered accounts here, you're going to have to basically accomplish different objectives. So apply the strategies within each accounts that are reflective of the objectives that you're trying to accomplish. At the end of the day, what we're able to do is we're able to reduce volatility within our portfolio. And what I mean by that, and that's that sort of day to day, week to week, month by month, fluctuation in value. So we can reduce volatility in our portfolios using options. We can generate income beyond the traditional approach using options, and we can leverage our capital with a defined risk, take advantage of different opportunities within the market, both bullish and bearish, by having a general basic understanding of the value that these particular strategies can bring to a portfolio. So I think if you start with that, if you start with the plan, you start with the basics that we've discussed here today, you've got the foundation to move forward and ideally be successful as a self-directed investor.
Well, thanks so much, Jason. Thank you so much for the value you've brought today. Thank you for being with us today.
Absolute pleasure. Absolute pleasure.
And for those in the live session, we now move on to questions.